Non-QM loans are not the risky subprime products that people think that they are. In fact, most buyers completely misunderstand how safe and flexible they've become. Non-QM has grown massively in the last decade, yet outdated myths keep people from using them, even though institutional investors and top lenders are pouring capital into this space. If you still believe these misconceptions, you're leaving smarter, easier, and sometimes safer financing options off the table in 2025. So here are the 8 misconceptions about non-QM loans. Before we get into it, I'm Andrew Russell, owner and founder of RCG Mortgage, 4-time winner of NAMB Broker of the Year, top originator across the country via Scotsman Guide, and I specialize in the non-QM space, working with clients to make sure they get the right products and achieve their goals, which is always real estate riches. All right, so here are the 8 biggest misconceptions about non-QM loans. In 3, 2, 1.
3, 2, 1.
A few moments later.
3, 2, 1. Sorry guys, my magic skills, they stink, so I pre-wrote it. It is what it is. But with that said, here are the 8 specific items that are such big misconceptions about non-QM. Start with the first one, subprime. So we've all seen the movie, right? The Big Short, no income, no job. So what does subprime mean? If you think of the subprime crash or the crisis, you had people putting really no money down, so the houses didn't really have much equity because it was assumed the rate of appreciation, right? If you bought a house for $600K, right? You remember they were in those movies, they were in Florida and the whole, town almost seemed like a ghost town because everybody was foreclosing and, a lot of squatters. So it was assumed that house was going up between 5 and 10% a year, that's what, they looked into and they realized this just isn't sustainable. Again, house values and appreciation goes up, depreciation goes down. Can't just go up 5 or 10% forever in perpetuity. So it's assumed you go on a new construction, think about it. You go into contract for 600 and then by the second year when it's built, now it's worth 660. By the year after that, now you're up to 700 plus. So the point is, if you put no money down, it doesn't matter because in a year, another year, you're going to have more and more equity. So, that was a big subprime feature, was lack of equity. Number 2 is credit profile. The credit profile specifically, we're a little bit, you say trash, not necessarily trash, but they were cool with something in the low 6s into the 500 score for these type of programs with not a huge income checked component to it, which is a little bit crazy. Bankruptcies, foreclosures, now it's kind of flipped the script. So non-QM specifically, typically you're seeing 680, 700 plus credit scores. This whole down payment thing where you put no money down back in the subprime days, before my time at least. Now people are putting 20% or even more down, so the equity positions are there. Then of course, adjustable versus fixed. So, most of these are getting 30-year fixed. So whatever your payment is, your payment is. So depending on your taxes and insurance, of course, taxes can get reassessed, insurance could go up. But at least your mortgage payment, call it $4,200 a month, will always stay $4,200 a month. You can prepay it. It'll just cut the term from a 30-year to a little bit lower, but at least that payment's not going up. Now, adjustables, people were taking 2-year, which is crazy, right? 3-year, 5-year. So you would have a nice low fixed rate for 2, 3, or 5 years, which is the whole kind of starter rate. And then what would happen? They would adjust. So when they adjusted, if they started going up, that means that $4,200 a month payment, now it's starting to creep up. And guess what you could do about it? Nothing. Or you could refinance. But guess what? Refinance, that's contingent on what loan programs are available at the time of refinance. So these equity positions, right? 600, now it's worth 700. If the equity in America during the crash goes down, now this house at 600 is worth 300 for argument's sake. Say that $600,000 house, you owed 600. As you can see, you're underwater, pretty hardcore. So you can't refi because banks lend off of your equity. So if there's no equity, you can't refinance. You see where this is going, right? Adjustables, payments going up. Oh my God, foreclosures. That was a big component of the subprime era. So again, how we've counteracted that in the non-QM side, I talk about 3 things, right? Credit, income, assets. So from a credit perspective, we're seeing less of some of the bad stuff, which is, again, bankruptcies, foreclosures, collections, not paying your bills on time. If you can't pay an $800 a month car bill on time, who's say you can pay an $8,000 a month mortgage on time? Logic kind of follows there. So that's a little bit more stringent, and that's popular now. So a little bit more conservative of a credit lens specifically. So that's why we're not going to have necessarily the subprime crash again. The income side, they actually are looking at some stuff on non-QM, which we'll talk about in a little bit. Some bank statements, some profit and loss programs, or even market rent. So it's not purely on air, it's on something. So that's a little bit more stringent. And of course, the third piece is the asset side. So as we alluded to here, down payments. Down payments a little bit higher. So it's just psychology. There've been so many articles on MIT and independent groups that have shown when you have a good chunk of equity, the likelihood of a homeowner walking away from that house and foreclosing is a lot less than if there's less equity. Because think about it, if you have an asset, that's all a house is, right? Think of it as a financial asset. Are you going to stop paying it if you have a lot of money value baked into it that if you sold it, you would get? No, you'd want to keep it. But if you have an asset that you're paying every month and it's not worth anything, or worse yet, it's underwater, it's actually worth negative, what's the likelihood of you not paying it? It's very high. So these are three specific things of why it's a typical misconception about non-QM, and the subprime stuff is just not here. It's not coming back. The second piece is default. Before we get into it, guys, just make sure you go in the description, click the link. We have a handful more items that we're going to talk about, but make sure you download our free guide to non-QM purchasing. My marketing team did an amazing job. They put together such a great, overview and packet for you guys. It's free, no catch. I'm not going to text you and stalk out your life to buy one of our services maybe. But just make sure you download our free packet, our non-QM buyer's guide. It's amazing. In the description, click the link. Make sure you grab it. All right, so the second thing is default. So I think everybody has, not that I have to write it out for you guys, what is PTSD? Anybody with a baby or a new kid, and you're out, and that kid poops itself, which may or may not have happened to my daughters multiple times, and you may or may not have forgotten the diaper, you have PTSD. I think that's a great illustration as it correlates to mortgage. Obviously, I digress. So there were so many defaults in this country. So again, the case of this example over here, people owed $600,000 on their mortgage. The value's tanked. Now that asset, that house is worth $300,000. They stop paying their mortgage. You go from a 30-day late to a 60-day late, which is 2 months, to a 90-day late. Eventually, you're 120 days or 4 months behind. And eventually, they consider you in default, which is foreclosure. Depending on the state you live in, it could take 7 years or more to actually foreclose. It could take a month or a week. So default is a big no-no in the industry. And it just basically means that the lender is going to take over ownership of the house, which they really don't want. They're going to probably have to fire sell it, and they're going to eat massive losses. So the goal of lenders lending all their monies is, I always say he or she who lends the money makes the rules. They want to make sure that small amount of interest, that they're getting back over the life of the loan, that it's being paid. So they look at the percentage of loans specifically that are defaulting. So out of 100, subprime loans, what percent of them were in default, which is, either 3 or 4 months behind. And if you remember all these movies, The Big Short, all these amazing financial guys, they got into this before ChatGPT. They got into all those Excels and they looked at all the loans and some of the qualifications. And they saw that the level of default was astronomical. So they realized that mortgage-backed securities, which is what all the mortgages kind of go into, it's like the master security of a bundle of mortgages that is probably going to default because there's a high percentage of them within that mortgage-backed security that are just not paying on time. Now, there have been some recent studies done that 3.8 and 0.03. So the default rate on these are as high as up to 3-ish%, which means, 3, 4-ish out of 100 might be behind a little bit on their mortgage, and 0.03 are actually credit losses, which means foreclosure, the servicer, they have to kind of take over the house and sell it and fire sell it. So these numbers are actually, comparatively to subprime especially, very, very low. In some cases, they're better than some of the vanilla loans, maybe like a government FHA mortgage. So for now, I can only speak about the here and now. The default rate on these is at a level where the market wants more of them because as a lending institution, he or she who's lending the money, these numbers over here from a default perspective are actually pretty good. So it makes sense at the interest rates they're offering to lend the money because for them it's profitable, which means downstream for the borrower that the products will be more available because it's more appetizing. Whenever someone wants to lend money, then all of a sudden the rates get a little bit better. They loosen up the credit guidelines. So it's just a good position to be in for non-QM. But it is a big misinformation that all these loans are all junky and there's going to be tons of default, which isn't the case. The third thing, of course, rates. Rates must be high because guess what? In the subprime, considerably if you didn't show your income. Conceptually, you thought that the rate would be a little bit higher. So the same thing applies to non-QM, right? Like clearly, if you're not getting a conventional mortgage like Fannie Mae, Freddie Mac, my boys, my girls, FHA, VA, because you're not getting these vanillas, when you go and you dip your toe into the chocolate, which we've always called non-QM, of course, when you get a non-QM mortgage, the rates are going to be so much higher, right? It's going to be a horrible program. No, it's actually not the case. So when they first come out, when these programs had first come out, so you say the gap, say the interest rate right now is about 6% for vanilla, right? So the gap would be anywhere between 2 to 4% higher for a margin. So the first programs that came out on the non-QM side were DSCR, right? That's more for the investment side, and then bank statement, which was more for the primary purchase, looking at 12 to 24 months. Bank statements, this was just purely on market rent. So we saw the margin between that 6%, rates were maybe 8% up to even up 10%. And what happened was the default piece, it deferred back to number 2. The mortgages, with the qualifications that he or she who's lending the money requires, we're paying on time, and the default rates were low, the actual foreclosure losses were low, so the margin on these has come down. So honestly, at this point, if 6% is the going rate, the margin's between 0 and 1.5% instead of 2 to 4%. So the point is, you can get a DSCR potentially in the 6s. You can get something into the 7s, and even that is a higher interest rate typically than market. So the point is that rates, there's a lot of misinformation out there. Rates are not all that much higher for non-QM, and sometimes they're actually the exact same. 2 teachers buying a house, first-time buyer, cool first-time buyer rate reduction programs with 30% down, 30-year fixed, could get the same rate. Or a DSCR client, someone showing nothing, buying the property in LLC, putting 20 or 25% down, seasoned investor, all on the market rent, no income check, can get the same rate as those teachers buying a primary house. It's super cool. The fourth thing is, you only do non-QM, right? If you get declined for, these vanillas, right? No, it's actually not the case. Some of these non-QM programs are just better fits. Sometimes in the condo space, non-QM is a little bit more flexible. So we'll put condo here on what condo requirements are. There was a horrible tragedy in Florida on a condo, or, within a condo development. And because of that, the national Fannie and Freddie and even FHA, VA guidelines for condos became very, very, very strict. So that's just one thing. For example, New York, it's a lot of condos. We've seen condo flexibility as being fantastic for non-QM. Or, depending on the rates, sometimes the rate on a non-QM, on the investment side, is better. You might find yourself quoted 7.5% on an investment, and maybe on the DSCR side, the rate's 6.5%. So they're not specific to just like, oh, you apply for plan A, and if plan A doesn't work, here's plan B. There are many instances that a non-QM mortgage is actually the go-to, and it should be over the Fannie, the Freddie, the FHA, the conventional mortgages are the typical loans. The fifth one is that they're super hard to access. That is not the case. So yes, when you apply for a mortgage, fun fact, you can do an FDIC, you can do a credit union, you can do a mortgage bank, and then you could do a broker. I'll make that one bigger, but I only do that because save the best for last, right, guys? Cheap plug. So when you apply for a mortgage, you can go to some of the larger banks, great institutions, Chase, Wells Fargo, Citibank, etc. Not as of yet. They just aren't offering non-QM loans. For what reason? Not really sure, but the big banks, they're just not offering these bank statement programs, profit and loss programs, for whatever reason. Credit unions as well, sometimes even more conservative than the big banks, just not offering them. Now, mortgage banks and brokers are. So typically, these are being offered by non-depository institutions from the mortgage bank side. What makes the broker the better option than the mortgage bank is the broker works with 100 banks, as an example, where the mortgage bank just works with one because they are the bank. So the good thing is, if you work with a great mortgage broker company, they will actually be on with all oodles, right? Oodles, I sound like a girl dad. Oodles of mortgage banks for the non-QM side. And what they'll do is they'll put in whatever your scenario is. Is it an investment purchase? Is it a bank statement purchase? Do you have a lot of assets? You want to do asset dissipation or depletion and get a mortgage based on your assets? Is it a profit and loss program? So they'll price it for you with all the lenders they're on with, which should be all of them, and they'll see who's the cheapest or the most cost effective and make sure, of course, they have great service levels, and that's who they'll align you with. So it's big misinformation out there. Access is all relative. And the whole point of a great mortgage broker is they will provide you for a small nominal cost access to all the lenders that offer these. But again, if you bank with some of the big banks, you're not going to be able to walk into your depository institution, sit with one of the reps there and say, hey, I write off all my income on my taxes. I heard these new bank statement programs from this guy, Andrew, I saw on YouTube, Brother Rage. Tell me about it. Do you offer them? Because the fact of the matter is that they don't. Just make sure you work with the right loan officer at the right type of company, which is typically a mortgage broker company. Somebody who has access to all the stuff. The sixth piece, that they're too risky. That is not the case. We talked about it in section 1. But what does risk mean, right? So risk to me is, are you getting fixed rates? So again, an adjustable, I remember during the crash, Newsday, a local newspaper, there's always the story of a mom, single mom, who got 2 mortgages on her house, for whatever reason decided to do an adjustable on both. And the crazy thing, guys, is many times the adjustable versus the fixed is not much of a difference. Maybe the adjustable saves you $100 a month, but 2, 3, 5 years later, is that $100 a month worth it? And if it is, should you even be buying the house in the first place to have such risk where you don't know in 5 years what the regulatory environment looks like, what does mortgage look like? I mean, there's AI and agentic AI and who even knows, robots at that point, but maybe their refinancing isn't really a thing. So the 30-year fix is a safe mortgage product because whatever payment you have, at least that's your payment over the life of the loan. So risk I've seen is always, will you get an adjustable and more of an exotic loan or interest only, which sounds good for today, but once the payment kind of goes up, you don't want to be in a place where you're left with no choice but to either not pay your mortgage or foreclose or sell. You don't want to put yourself in a position. So from a risk perspective, most of our clients are getting 30-year fixed. I'm saying 99.99% of them. So risk we've seen mitigated vis-a-vis just the loan product they're taking. And of course, risk on the other side of the fence from that is something called reserves. So think about it. If you bought $1 million house and you put 20% down, and that's an $800,000 loan, your payment's $5,600. Throw darts in the dark. Maybe a $7,000 payment with taxes and insurance. Would you want to close and have $83 to your name after you close? No. That's crazy, right? So there's something that they've rolled out called reserves or a reserve requirement. So in the case of reserves, the mortgage payments say, what do we say, it was $8,000-ish, $7,000, $6,000. That is considered 1 month of reserves. So they like to see as an example a year's worth of reserves. So if your payment's $8,000 a month, which is a very high mortgage payment, times that by 12, that's a little less than $100,000. So ideally, the lenders don't feel they're risky because they want to see you have reserves. Or if something happens, if your business doesn't do well, or you need the rainy day funds, or the roof goes, or God forbid you want to redo a section of the house, that you actually had money to do that, you're not taking more debt or more loans. So the reserves, safe rule of thumb is 12 months. So whatever your mortgage payment is, if you're doing a non-QM loan, and then if it was me, I would do the same thing, because there's nothing worse than the feeling of being not in control, especially of your financial side. Maybe you're married, maybe you have kids. There's a lot of dynamics there. So just make sure when you close, and this is just advice in general, that you have at least a year's worth of mortgage payments. Because think of how safe and comfortable and content you'll be if no matter what happens, the house is paid for a full year, even if you don't do all that well at your job. So these are some of the reasons why lenders think that the current iteration of non-QM isn't that risky. Of course, besides an adjustable and being a fixed rate, clients are required, mandated to qualify that they have reserves, which is money left in the bank, to a decent extreme after we close, which wasn't really necessary during the subprime days. Now, the 7th item, non-QM, they've been around for a minute. It's just for investors. These type of programs, from 30, 40, 50% down, just purely for investors. So that is not the case. If you think about the, purpose of an actual mortgage when you're buying a property, there's primary, there's second home, there's investment. So investment, sure, but that's only one of 3 types or purposes of why you're buying this property. So on the primary side, these are accounting for a large portion of these non-QM loans, specifically bank statement review, reviewing bank statements to ascertain income for a self-employed client, a P&L program, looking at a P&L over the last 12 months, going off of the net profit, asset program where you look at, hey, you're getting $1 million loan, but you have $2 million liquid in the bank after you close, you qualify. That's it. No questions asked. Did you have it for 6 months? You qualify. I mean, how cool is that? 1099 programs, if you're a real estate agent or if you're a 1099 contractor, instead of looking at your Schedule C, where you write it all off and it never looked good anyway, we look at your year-to-date and then last year's or the last 2 year, depending, 1099s. And if the income trend on the 1099 is the same or going up, we just average it. We don't look at anything else. Isn't that cool? But that's all primary purchase stuff. Of course, the investor side has only grown and gotten more aggressive, meaning you can buy a one-family property, DSCR, non-QM, being an investor, and put 10% or even 15% down. Now, I don't recommend it. The rate is spicy, to say the least. 20% down is the best strike point for typical DSCR purchases, but it went from 1-unit properties and condos to 2 to 4 unit properties to now 5+. We've seen 10 to 12 unit plus properties qualifying for DSCR. So initially, maybe these programs have been around on the commercial side for investors where you put money down, it's on the market rent, but it's opened up to primary and second home purchases. They look at income in a couple different ways, so no. Non-QM loans are outstanding for real estate investors, but not just specific for that demographic. Now you'd say you save the best for last, but scale. So typically, some of these loans, the Fannie, Freddie, and FHA loan, the VA loan, there's only so many you can get. Now the good news, scale of these, there hasn't been a cap that's been put in. So if you are a real estate investor and you want to buy 12 of these at the same time, by all means you can. You know, sometimes there was a cap on 1 to 4 or 5 to 10 with Fannie or Freddie. So now there's no cap. So as long as you qualify, every single property that you like, there's scalability opportunity, because as long as you have the down payment, or you buy, you hold, the house goes up in value, you pull money out, you buy the next one, it can really go on, you know, quote unquote, until these programs are offered in perpetuity or infinity. So there has been some, you know, discussion of scale and how it was restricted because there was concerns on the Fannie and Freddie side of, like, what happens if that one individual who owns so many properties, something happens to them, maybe God forbid they pass away or they lose their job or something happens in the area that they're focused on. There's going to be a lot of losses for that one person. For now, there are no issues from a scalability perspective. So DSCR, you can buy as many as you want as long as you qualify for each one and you hit the program guidelines. And even on the primary side, whether it's a bank statement program or a second home, as long as you qualify and you're meeting the occupancy requirements and you're in the house for long enough, scalability or issues with it is a thing of the past. All right, guys, so these were the 8 biggest misconceptions about the non-QM space. But make sure you watch our next video where we go into the challenges that you learn, unfortunately, when you apply for a non-QM loan too late. So our next video is all the challenges in the non-QM space and what you oftentimes find out too late on the back end. Make sure you watch the next video and prepare yourself for non-QM.